Hello and welcome everybody back to the Lion of Crypto channel. Hope you're all having a fantastic day. If you haven't already, make sure you're subscribed and following. This channel gives you the real crypto intel before it hits the mainstream. The financial system is being quietly rebuilt from the ground up, and almost nobody is paying attention. 6 moves, 6 signals. And by the end of this, you will never look at your money the same way again. Because what we are witnessing right now is not noise. It is not speculation. It is infrastructure being repositioned in real time. We are moving from a bank-centered system to a ledger-centered system, from slow settlement to instant finality, from closed networks to programmable money. And the most important part is this. The transition is happening quietly through policy proposals, retirement legislation, institutional partnerships, and supply chain upgrades. Macro always leads. Liquidity always finds efficiency, and efficiency always rewrites the rules. We are late in the long debt cycle. Sovereign balance sheets are stretched. Settlement systems are outdated. Cross-border payment rails still operate on 1970s architecture. The global financial system clears hundreds of trillions annually, yet much of it still relies on batch processing, correspondent banks, and multi-day reconciliation. When stress rises in a system like that, 2 things happen. Central banks look for control, institutions look for efficiency, and real crypto infrastructure sits at the intersection of both. The first signal came from the Federal Reserve itself. For the first time in history, the Fed is actively considering allowing select non-bank financial entities to maintain accounts directly with the central bank. That includes stablecoin issuers, regulated digital asset firms, and payment networks. And Ripple submitted a detailed response to the Federal Reserve's request for input on what's being called a new payment account prototype, effectively a Reserve Now transaction bridge. Pause there. Right now, if a crypto company wants to access the U.S. financial system, it must go through a commercial bank. That bank sits between the company and the central bank. That bank can delay settlements, freeze accounts, terminate relationships, apply balance sheet constraints. But if non-bank financial entities receive direct Federal Reserve accounts, they are no longer tenants of the banking system. They become peers within it. That changes everything. Settlement moves from correspondent banking to direct central bank clearing. Liquidity becomes programmable. Counterparty risk collapses, and suddenly digital asset infrastructure is no longer bolted onto the legacy system. It is integrated into the core. Ripple's submission was not a marketing pitch. It was a formal, compliance-based response. They effectively told the Fed that the infrastructure exists, the compliance controls are in place, and the demand for real-time settlement is growing. If the Fed approves a framework like this, the architecture of U.S. payments changes permanently. And when infrastructure changes, capital follows. Now, let's zoom out to the second signal. While the Federal Reserve is contemplating direct access for digital infrastructure, the Indiana Senate passed HB 42, allowing retirement funds to invest in digital assets. This is not retail speculation. This is pension capital. Retirement funds are structurally different from hedge funds. They allocate with decades-long time horizons. They do not trade momentum. They build strategic exposure and hold. When retirement capital allocates to an asset class, 2 things happen. Volatility compresses over time and supply gets locked away. Indiana is the first domino. Every other state, treasury, and pension board is watching. If this model proves politically and financially viable, the replication effect will be powerful. Think about the scale. Public pensions in the United States manage trillions of dollars. Even a low single-digit allocation to digital assets represents tens of billions in structural demand. And this demand does not rotate in and out. It accumulates. This is how markets mature. First comes infrastructure, then comes regulatory clarity, then comes institutional capital that does not leave. Now layer that with what is happening at the protocol level. In a recent podcast conversation, a fintech CEO made something very clear. His company was not experimenting with XRP. It was built around it. Not because of hype, not because of price action, because of utility. The XRP ledger was designed for settlement efficiency, fast finality, low transaction cost, native asset issuance, built-in decentralized exchange functionality, compliance-aware architecture. While much of crypto chased meme cycles and narrative rotations, XRP focused on payment corridors, liquidity bridges, and tokenization of real-world assets. Tokenization is not theoretical. It is the digitization of bonds, real estate, commodities, and funds onto programmable ledgers. Once assets are tokenized, they can settle instantly. They can be fractionalized. They can integrate with automated liquidity pools. That CEO made the point clearly. Finance is moving on-chain. Settlement will not happen in days. It will happen in seconds. And the ledger that can handle compliance, throughput, and integration with traditional finance will be the ledger institutions choose. This is not about competing with other crypto tokens. It is about competing with Swift correspondent banks and multi-day reconciliation. Now, let's connect this to the US Treasury. Ripple is not trying to replace the dollar. It is trying to move the dollar more efficiently. Treasury operations involve trillions in issuance, settlement, and cross-border flows. Much of it still clears through layered intermediaries. If you build private ledger infrastructure that integrates with government-level finance, you do not need headlines. You need functionality. Ripple has spent years developing payment rails, custody solutions, and liquidity infrastructure. They acquired Metaco to strengthen institutional custody. They expanded licensing footprints in multiple jurisdictions. They aligned with regulatory bodies rather than resisting them. Infrastructure first, adoption second. This is how long-term system shifts occur. And it does not stop there. The fifth signal comes from one of the largest banking institutions in the world, HSBC. HSBC has been expanding its tokenization efforts across multiple jurisdictions. UK bond tokenization, Luxembourg digital asset initiatives, Middle East expansion into tokenized securities, gold tokenization through Project Orion. Now, look at the pattern. In the United Kingdom, Ripple secured regulatory approval from the Financial Conduct Authority. In Luxembourg, Ripple received a full electronic money institution license from the Commission de Surveillance du Secteur Financier. In Abu Dhabi, RLUSD achieved official recognition within the Abu Dhabi Global Market Framework. Market by market, regulatory footprint by regulatory footprint, there is overlap. HSBC's digital asset platform has facilitated billions of dollars in tokenized bond and digital asset transactions globally, and Ripple-owned Metaco provides custody infrastructure integrated into institutional-grade solutions. This is not coincidence. This is ecosystem alignment. Tokenized bonds settle faster. They reduce reconciliation risk. They create programmable coupon payments. They allow fractional participation in traditionally illiquid instruments. When global banks begin tokenizing sovereign and corporate debt, they are not experimenting. They are modernizing capital markets plumbing, and they are doing so in jurisdictions where regulatory clarity exists. Follow regulatory clarity. Follow infrastructure deployment. Follow capital migration. Now we arrive at the sixth signal. FedEx joined the Hedera Governing Council. At first glance, that might seem disconnected from payments. It is not. Global supply chains are deeply financial. Every shipment represents working capital, represents customs documentation, financing arrangements, insurance contracts, and settlement obligations. Today, supply chains rely on fragmented databases. Data mismatches cause delays. Fraud increases costs. Disputes tie up capital. Distributed ledger infrastructure allows shared tamper-resistant data verification across multiple parties. When shipment data is verified in real time, trust costs decline. FedEx is not experimenting from novelty. It is seeking operational efficiency across millions of shipments. If cross-burst shipment data becomes verifiable in real time, trade finance accelerates, payment release conditions can automate, insurance triggers can digitize. The future of supply chains is not just about logistics. It is about synchronized settlement between physical goods and digital value. Now step back and observe the pattern across all six signals. The Federal Reserve, exploring direct access for digital financial entities. State retirement systems opening allocation pathways to crypto. Fintech companies building natively on settlement-focused ledgers. Treasury-level infrastructure quietly integrating modern payment rails. Global banks tokenizing bonds in Ripple-aligned jurisdictions. Global logistics giants adopting distributed ledger governance for shipment verification. This is not retail-driven narrative. It is institutional modernization. Why does this matter for crypto broadly? Because crypto's next phase is not speculative mania. It is capital market integration. When infrastructure aligns with regulation and regulation aligns with institutional mandates, the asset class transitions from fringe to foundational. Liquidity expands not through hype, but through utility. Now let's focus specifically on XRP. XRP was designed as a bridge asset. Currency, pairs. It settles in seconds. It minimizes pre-funded nostro accounts. In a world where central banks are considering direct digital integration, and banks are tokenizing bonds, and governments are modernizing treasury operations, the demand for real-time settlement increases. XRP does not need to replace fiat currencies. It needs to facilitate them. If tokenized assets move across borders, they require liquidity bridges. If stablecoins require instant conversion, they require settlement layers. If retirement funds allocate into digital assets, they require custody, compliance, and liquidity infrastructure. This is where XRP sits. It is not about speculation. It is about throughput. Institutions care about three variables: cost reduction, risk reduction, and speed enhancement. If a digital asset network can reduce capital lockup, compress settlement times, and lower counterparty exposure, it becomes economically rational to adopt. That is the institutional lens. Now consider regulation. The fact that the Federal Reserve is soliciting feedback from digital infrastructure providers signals engagement rather than exclusion. State legislatures passing crypto-friendly retirement laws signal political normalization. Regulatory approvals in the UK, Luxembourg, and Abu Dhabi signal jurisdictional acceptance. Clarity does not arrive in a single announcement. It arrives through incremental frameworks. And once clarity reaches a threshold, institutional capital deploys at scale. We are approaching that threshold. In the short term, volatility will remain. Markets overshoot, narratives fluctuate, headlines create noise. But beneath price action, infrastructure continues to build. Short-term traders focus on candles. Long-term allocators focus on plumbing. The plumbing is being upgraded. Pension funds begin accumulating. Supply tightens structurally. As tokenized bond markets expand, settlement volumes increase. As central banks modernize account access, integration accelerates. Liquidity is the oxygen of markets. When liquidity improves in speed and accessibility, asset classes re-rate. That does not happen overnight. It happens in waves. We are in the early stages of that wave. The long-term outlook becomes clearer when you frame this as a decade-long transition. Just as the internet moved from dial-up experimentation to broadband infrastructure to cloud-native dominance, financial systems move from legacy batch processing to digital settlement layers to fully programmable capital markets. Crypto was phase 1, proof of concept. Tokenization is phase 2, asset migration. Institutional integration is phase 3, structural adoption. 2 and XRP sits squarely at the intersection of liquidity and compliance within that transition. Now let's think in generational terms. Retirement funds allocate for 20 to 40-year horizons. Central banks design systems meant to last decades. Global banks do not invest billions into tokenization pilots without long-term strategic intent. When multiple layers of the financial system move simultaneously, central banks, state legislatures, global banks, logistics giants, it signals systemic adaptation. The existing system was built for a paper-based world. Settlement delays were tolerable when capital flows were slower and globalization less complex. Today, capital moves at the speed of information. Markets trade 24 hours. Supply chains stretch across continents. Sovereign debt levels require efficient financing mechanisms. The old rails cannot handle the new velocity. Digital asset infrastructure is not an ideological movement. It is a performance upgrade. XRP's long-term value proposition rests on transaction velocity and liquidity bridging. If global settlement volume migrates on-chain, bridge assets that minimize friction become increasingly relevant. Add tokenized treasuries, add tokenized corporate bonds, add cross-border payroll systems, add trade finance automation. Each use case compounds network demand. Institutional adoption rarely looks dramatic at first. It looks procedural. Regulatory filings, pilot programs, quiet council memberships, limited jurisdictional approvals. But when enough procedures accumulate, the shift becomes obvious in hindsight. We are watching that accumulation now. In the short term, markets will continue to oscillate between risk-on and risk-off cycles. Macro liquidity conditions will influence flows. Interest rate expectations will impact risk assets. But structural modernization does not reverse because of quarterly volatility. Long-term, the integration of digital asset infrastructure into central banking, treasury operations, pension allocations, capital markets, and supply chain logistics suggests a multi-decade transition. The question is not whether the system will modernize. It must. The question is which protocols, which assets, and which regulatory frameworks will anchor that modernization. XRP has positioned itself within payment corridors, regulatory jurisdictions, institutional custody infrastructure, and liquidity bridging use cases. It does not guarantee dominance, but it places the asset directly within the conversation where real financial migration is occurring. And that is what matters, because once infrastructure is embedded, it becomes difficult to replace. Think of SWIFT, think of networks, think of clearinghouses. They persist because institutions build processes around them. If digital ledgers become embedded within treasury operations, bond markets, pension allocations, and trade finance, they too become foundational. The 6 signals we discussed are not isolated events. They are puzzle pieces. A Federal Reserve exploring direct integration. A state legislature unlocking retirement capital. Fintech leaders building natively on settlement-first architecture. Treasury-level infrastructure modernization. Global banks tokenizing billions in assets within Ripple-aligned jurisdictions. A logistics titan embedding distributed ledger governance into global shipments. Individually, each headline is interesting. Collectively, they are transformational. The financial system is being quietly rebuilt from the ground up, and most people are still debating last cycle's narratives. When capital market plumbing, upgrades, value accrues to the infrastructure layer, that is the lens through which you should view this moment. Not as hype, not as tribal competition, but as macro evolution. We are witnessing the digitization of money, assets, and trade. And if you understand where liquidity is going and why, you position yourself ahead of the curve rather than reacting to it. Because by the time the mainstream recognizes the shift, the infrastructure will already be in place, and the capital will already be allocated. If you found value in today's breakdown, don't forget to like the video and subscribe. This is Lion of Crypto, and I'll see you in the next.